And we are live. Welcome back to Brotherhood Finance LLC. Today we have ColeNichter, the other CEO of Brotherhood Finance. We're going to be addressing the stock market, crypto, real estate, how the markets are doing overall, my thoughts, my opinions on everything. Everybody welcome ColeNichter, again, the other CEO. He does the TikTok and the other business management of Brotherhood Finance. I'm ready for today's stream. How we doing, Cole?
Doing good, man. Doing good. How are you?
Yeah. Good, brother. Good.
So, tell me a little about yourself. Obviously, you run a little bit of the YouTube, and I think everyone. Tell me, you going to school right now? What are you doing?
Yeah. So I'm studying aviation management at BGSU, and then I'm going to be minoring in business. I'm currently entering my junior year. I went to the Toledo Aerospace Academy and got my aircraft mechanic license, and I'm also working on my private pilot license. And then obviously we grew up together, so I would like to tell the audience about yourself as well. But yeah, man. So I've been running obviously the Brotherhood Finance YouTube, and you've been doing great with the TikTok, and I'm excited to dive into some important information and stuff like that, as well as some personal information as well. So Cole, tell us a little bit about yourself as well.
So, I just graduated high school, going into my freshman year at Flagler College up in St. Augustine, Florida, and I played on the under-17 USA team for lacrosse, and I'm looking to pursue. I'm actually getting my real estate license right now as we speak in Florida,
Yeah.
and I'm getting my master's in business and minor in finance. So,
Heck
hopefully,
yeah.
as Brotherhood Finance goes on, we see a nice incline in not only supporters and people that are surrounded by us, but as well as we can bring you the best information possible, and not just based on what you see on TikTok and all over social media, but based on facts and statistics.
Right. Yeah. And I mean, again, I believe we bring, a very vast and massive amount of information to the audience on how they can, increase their return on investment, start investing at a young age. I know at Brotherhood Finance, we also preach how time is our best asset.
Yeah.
Warren Buffett and many other entrepreneurs got rich off using time as their best asset. And really, adding value and adding to your financial education so we can, obviously attain what our goals are, which is financial freedom and
Yes,
having
sir.
our assets pay for our liabilities.
Of course. So I guess the first question I have for you, Brendan, is what is the state of the market right now? What do you see? I guess whether it's let's start with crypto. Everyone, crypto's brand new. People don't know a lot about cryptocurrencies. We're all still trying to figure out where crypto's going. Obviously, we see a fluctuation in the market. We see crypto one day is at 60,000 in Bitcoin, and then in the next minute it's at 30. Can you explain kind of what's happening in the market and why we shouldn't be worried, or should we be worried?
Yeah. So first, let's take a step back real quick. So I want to talk about crypto as a whole and where I see it and how it's an innovating technology. So I know I've told you, and I told many of the audience at Brotherhood Finance, is I see crypto as kind of like the internet of the 1980s, 1990s, because it can add so much value and information and really help companies and corporations. Bitcoin, if we talk about Bitcoin, obviously we know there's a finite amount at 21 million. It's like an AI super soldier asset, as real Marsh Wilkinson would like to say. And that's again because there is a certain amount of supply. And therefore, since the supply is limited, the demand increases while the supply is limited. Now, when they print more and more money, how they print all these trillions and trillions of dollars, that makes the value of your US dollar that you work so hard for go down. That's why savers are losers and the rich invest in assets, Robert Kiyosaki, because the wealthy know you can't work your whole life without investing into an asset vehicle that's going to get you that return on investment and allow you to retire at the proper age. So the crypto markets right now, people have to understand they're new, they're volatile. I think it's going to be a very innovating technology in the future. I think we're still very early. If you look at some of the statistics, only about 13% of people have actually adopted crypto. So we're still very early. Michael Saylor, one of the biggest CEOs of one of the MicroStrategy, one of the largest Bitcoin firms in the world, he believes the whole crypto space as a whole has more than a 200x upside. So
Okay.
massive returns potentially. Again, it is new, so it has a lot of volatility that are in the markets. I'll go back into crypto, but as far as the real estate market goes, I know I'm going to dive into some slides here real quick. But as far as the stock market goes, people have to understand that with all this money being printed, there obviously it's going to go back into the stock market overall, and that's going to inflate the stock market more, and it's going to make those assets overvalued, especially large cap companies as well.
For sure. So I guess why is Bitcoin or why is Ethereum or any of the cryptocurrencies a good investment? And what is the difference between, I guess, a good
Sorry about
investment,
the light real quick. Yeah, that was
a good,
I'm
a
turning that
good,
back on right now.
a
But
good investment in crypto, and what's not a good investment in crypto?
yeah, so crypto. So what is a good investment? Why are they good investments? How do they add value? So I know me and you, we preach a lot about what the good assets in crypto are, and really, I think you'd agree with me on this. The top three investments that I prefer in the crypto space are Bitcoin, Ethereum, and ADA. So with Bitcoin, again, you have like an online digital gold AI super soldier where there's a finite amount you can invest in an asset, and it's going to store your wealth as well as increase your return on investment over time. And then with Ethereum, you have smart contracts and you have EFTs. And the EFTs, you can buy digital art. And as well with the smart contracts, corporations can get into that. It can take lawyers out of the picture, so it can add, a tremendous amount of value to companies and corporations as well. And then with ADA, it uses smart contracts. Not smart contracts, I'm sorry. It uses the proof of stake method. So what the proof of stake method is, it can allow for faster transactions, less fees that are associated. And as we have progressed throughout history and time, Cole, we've noticed that over time, we have made things less and easier. So you used to go to the movie theater to watch a movie. Nowadays, you just go on Netflix. So I think it's going to be the same adoption curve that's going to occur with how we deal with money, especially as they continue to print and print and print more money, which devalues your dollar, making other cryptocurrencies, that add value like Bitcoin, Ethereum, and ADA, that add a tremendous amount of value to to corporations and to the people. It's going to further increase the return and the expectancy value of that asset in the future. So massive upside.
For sure. So I guess my next question is, what is the state of the market in real estate? How do you see the real estate investments going, and how do you see, I guess, the market as a whole? I know people are talking about maybe a major crash here, like in 2008. Is that something you foresee in the future, or what's your opinion on that?
So personally, I believe, obviously the stock market, I believe that's overinflated. But what we really have to focus on right now is obviously lumber, gasoline, all of these other, commodities and stuff like that are going at a tremendous amount of upside because of all the inflation that's occurring from the massive amount of money printing. As far as the housing market goes, I do believe we are in a bubble overall. However, I don't think that bubble will pop for another 3 to 4 years. However, there will be mortgage forbearances, which pretty much means when the renters cannot pay. They've had mortgage and rent forbearances for quite a while now. There was a 1-year policy and a 2-year policy that they applied during COVID-19. So I think once those expire, there will be a little bit of hurt in the commercial marketplace. However, I don't think the overall markets in general are probably going to pop for another 3 to 4 years. But I think when they do pop, we're going to see probably an asset devaluation or drop of around 30 to 50% in real estate. Just because, and I was watching a podcast and they brought up a very important point. And it was, when you go to your dentist and he talks about Bitcoin, he talks about real estate, and he talks about all these other assets and how real estate's at an all-time high and all that stuff. There's a huge amount of hype, and the marketplace right now is really just overvalued in general. And
I mean, is that with anything though? That's what I feel like. Even like people, for an example, like that GMC push or the the AMC and
those are
the
all
GME
spec plays. There's no value in a majority of the Wall Street's bets even. When you see things like that, that scares me. That's not the kind of investor I am. I know that's not the kind of investor you are. I sit down and look at the balance sheets. I look at the net operating income. I look at the liquidity, the cash on hand. I look at if they're a profitable company, if they're expanding, if they have growth, what the quarter 1 through quarter 4 results are. And I look at the overall basis of the company and see if, they're net cash flow positive. They have positive cash flow, because cash flow moves every corporation, every business. It's very important. And then I look, okay, where's this company going to be in the next 5 to 10 years? Is it adding value? How does it add value to, the community or the product and service that they're delivering to the people? And a lot of these spec plays that people are doing, there's no get rich quick. I mean, you can use time as your best asset. You can invest in an asset for the long run and you'll get rich over time. But there's not really any get rich quick. And what I see with the GameStop, the AMC and all that stuff, it's all spec, and it's, I think it could possibly be a disaster. I know people have made money in there, but you also see a tremendous amount of people that have lost money in those assets from the FOMO, fear of missing out, that have invested and lost money that you don't hear about as well.
I mean,
so that's why I think it's very important to invest in assets that have value and that you understand, especially with crypto. So many new people are investing in crypto and they invest in Dogecoin, for example, right? Dogecoin is a very manipulated asset. And the reason I say that is because they can make any amount of Dogecoin at any point, the creator do, as well as what they call whales. Whales are people that own a majority amount in a given asset. So there's tremendous amount of whales and Dogecoin that can easily spec the market up or down by buying and selling. And other assets like Bitcoin, they add value. There's 21 million. There's 18.4 million mined. The supply is limited. And again, it's on the blockchain servers, and you're going, okay, well, why would people adapt crypto over the US dollar? Well, first, the US dollar, you do not want to save money. Again, savers are losers. Why do I say that? You invest your money in a bank account, you're going to yield 0.0125% average. So it's going to take you 48 years to earn 10% on your money. Just some statistics for you. These last 2 years, they've printed 24.5% of every US dollar.
That's crazy.
So that's why, the rich invest their money. They're not holding on to a whole bunch of cash. And if they're holding on to cash, they're waiting to buy the crash, because the rich get richer when the crashes occur. I know that's something me and you have talked about tremendously, and we're very we're actually excited for the crash. I'm excited for it.
Yeah.
I mean, it's a great opportunity to buy these undervalued assets and accumulate a lot of them.
Mm-hmm. So I guess kind of diving into the crash, and if I'm a college student, or maybe even a young adult, and I'm making, let's say, $50,000 a year, the average US salary income.
Mm-hmm.
How should I be balancing me investing but also living my everyday life? I know for people like out there that are making 50, 60,000 a year right out of college, that they may feel like they don't have money to invest. What do you have to say about that?
Yeah, so the first number one problem I notice with people, especially in our generation, Cole, is they spend more than they make, and as well as they don't. You gotta look at your income and your expenses. So you have to keep your income higher than your expenses, and there's many ways of doing that. So if you earn $50,000 a year after taxes, you'll probably bring home let's say $42,000. So you want to live off of $15,000 to $20,000, and then you want to invest in an asset. What I do and what I tell people is keep roughly 20 to 30% in cash. That's what I'm doing right now. With 50K a year, obviously keep your expenses low, keep your income high, and don't invest in liabilities. Most people say, well, I just got a car. A car is not an asset, it's a liability. Where is the cash flowing? Is the cash flowing in or out of your pocket? So if the cash is flowing out of your pocket, it's a liability. If it's flowing into your pocket, like let's say we own, apartment, buildings in the future, we own commercial real estate, that's cash flowing every month. It's also cash flowing, but we're collecting appreciation, okay? The asset price of the house is going up in value, okay? So that's appreciation. And in addition, we get to write off the house as a tax write-off, or the commercial real estate, because we're providing, things that the government cannot provide. They can't provide housing, and they can't provide healthcare as well. So we have, you have to invest in industries and invest in an asset class where you have those benefits. And that's why if you study some of the richest people in the world, they own assets like the stock market or real estate, or they have commodities, gold, silver, Bitcoin, the AI super soldier, of Bitcoin. So, you have to understand, how do you manage the money? And the first thing is you got to look, where is your money going, and how can you keep your expenses lower and invest into an asset? Because there's really no other better way. First off, you have to save your money. So
Yeah.
what school doesn't teach you is they don't teach you how to invest. They don't teach you how to do taxes. They don't teach you how to build credit. Instead, they teach you the things that you don't need to learn and you don't need to, that you're not really going to use in life. What you need to learn on first off is the 3 rules. And it's earn. First, you're going to earn money. Then you're going to keep it. That's not the hard part. You can earn and keep money pretty easily. The third part is the hardest part. You have to multiply your money. That's the only way you're ever going to achieve financial freedom. So that is what you have to do. So you earn $50,000 a year. First off, earn it. Then you have to keep the $50,000 or the most of that $50,000 that you can keep. And then you have to multiply your money to increase your return on investment.
For sure. So I guess my next question for you is what is Robert's rule about real estate? And who is Robert Kiyosaki? I know a lot of people that want to become real estate agents and want to become, invest in the real estate, have that passive income and that cash flow, obviously multiplying instead of adding, because they teach us that in 2nd grade, you multiply quicker than you add. And so I guess what is Robert Kiyosaki's rule, and what book do you suggest people start reading if they're interested in real estate?
Yeah. So before you even get in real estate, I think you should first off understand the fundamentals and how to gain financial education, because you have to, first read a lot, research a lot, watch people to gain the financial education to understand how to invest in certain asset classes. So first I would start with, the markets or something, and then I would move into something bigger like real estate for the perks, like I was saying, appreciation, tax write-off, cash flow, and some of the other benefits that you can use, as well as tax code 10301, where you can invest one piece of real estate into another piece of real estate without paying taxes. Another way the rich don't pay taxes, but that's a side note. So Robert's key rules is first, you have to understand the rich don't work for money. So that's his number 1 rule. In the book, I would recommend people to start learning or start reading first would be Rich Dad Poor Dad, Robert Kiyosaki. So that goes through his life, what he did, how he had a rich father and he had a poor father. Now, most people would think, okay, the rich father probably went to college. He got an education. It's actually the opposite way. The rich father was one who didn't go to college. He got his GED and he had his own real estate and his own business. So what people need to understand is there's 4 quadrants, and Robert Kiyosaki talked about this. So there's the employee, and the employee is 95% of people. Most people are employees. And when you collect that paycheck, first off, you're satisfied with your paycheck. And as well, you're taxed the most when you collect your paycheck. So most people are employees. Then there's investors. Investors do all right, because if you invest in like a Roth IRA, you can put $6,000 a year in. If you want to check that out, we have a video on the Roth IRA, becoming a millionaire. It's literally the easiest way to become a millionaire. You literally just put some money in a Roth IRA. You can maximize it at $6,000 a year. It's you don't have to pay taxes after you turn 59 and a half. And I think at the age 18 or 19, Cole, you ran the calculations. What was it? You'll retire with like 2.4 million or something.
3.1 million.
Yeah, 3.1 million if you max it out. So, it's the easiest way to get rich long term, but most people want to get rich quick. So you have to invest in other asset classes. But one of my other favorite books to read, obviously, is the 10X Rule, Grant Cardone. So Grant Cardone, he is one of the best people you will learn from about real estate, especially commercial real estate. When I'm talking about commercial real estate, I'm talking about multiple units. So multiple units that are cash flowing, appreciating. So one of the main indicators I've noticed, Cole, especially just most people, even some realtors, is they think, okay, if I own one asset and I own one house and one room, that one door is more risky than owning 10 or 12 doors. And you're going, okay, well, why is that? It's because the less doors you have, if that one tenant moves out, you're negative cash flow for a multitude of months. However, if you own
people shouldn't invest in single family homes, is what you're saying. So let's say, for an example, I'm in Florida and I want to rent out my house as an Airbnb. If I have 2 houses, do I sell the one or do I rent the other one out? What would you suggest there?
Yeah, so I would probably rent the other one out still.
Okay.
I'm not against the single family, because you still get the cash flow. However, you have to have a relationship with the tenant, in my opinion, to just fulfill your ideology, and that you're going to get that cash flow every month and he's not going to move out. But to learn the real estate game, I think starting with one unit's okay. However, you're safer investing into a multifamily or a commercial real estate asset that has more doors. So you still get that continuous cash flow. And your occupancy is, okay, is the apartment building occupied? So if 8 out of 10 people and you own 10 units and those 8 units still live there, but the other 2 don't, you're still positive cash flow from that commercial real estate building. Okay, so you're still, but with 1 unit, you'd be negative cash flow. So that's where I think most people go wrong in the real estate game. Also, another thing that Grant Cardone talks about, again, like I was saying, one of my favorite, I think he's one of your favorite entrepreneurs as well in the real estate game. Is he talks about leverage. So what I was saying before with Robert Kiyosaki is they're the similar mindsets. So you have to understand these entrepreneurs, they learn from big businesses, wealthy people, and they most of them share the same qualities and traits. They don't use their money. No. So, one of the rules Robert also talks about is the rich don't use their money. They use other people's money. So you have to understand when you're investing into a commercial or multifamily or a real estate asset in general, you're not going to be using a bunch of your money. You're gonna leverage your money, which means, okay, Cole, I'll give you $10,000 and I'll be able to buy $120,000 worth of real estate. So it's the same way. If I'm going to buy, a 12-unit apartment complex for $1.2 million, me and you, Cole, are going to go, okay, we need about $300,000, $400,000 of liquidity, cash on hand to invest in this asset.
So if for an example, let's say I work at McDonald's, right? There's people out there that are watching a stream that work in the retail, they're working their 9-to-5 job, whether they're making $10 an hour, whether they make $30 an hour. Do you think that makes a difference in how they can invest in real estate? What if their first issue is, hey, look, I work at McDonald's. That's their excuse. What do you have to say to people that use that as an excuse?
So the first thing I would say to those people is, obviously, you have to accept the fact that you're, first off, not going to be working at McDonald's. You have to accept the mindset and develop that positive mindset that, first off, you're going to 10x your life and you're going to invest in these assets and these properties, as well as an asset vehicle in general. So the first thing I would say is, even if you work at McDonald's, it's fine. Work at McDonald's and show up at work every day being the best employee there. And after you accomplish that, obviously, like I was saying, keep your income high and try to keep your expenses low. And if you don't have a whole bunch of money to start in real estate, start learning about real estate, and also find somebody you can partner with in real estate. Because like I was saying before, you don't need a whole bunch of your money. You're going to be leveraging other people's money. However, if you find someone to partner with, that helps you pretty much increase the amount of units and cash flow you can receive every month exponentially, because if 2 people go on a real estate deal, you can pretty much double the amount of the loan that you can receive and double the amount of liquidity that you can put down to buy more units. Okay. So that's what I would say to those people.
So I guess the next question I want to dive into, if you had $1 million, what would you do with it?
$1 million, what would I do with it? So the first thing I would do probably is I would probably put about, are we talking right now and today?
Today, right now, okay. I gave you $1 million. What would you do with it?
So $1 million, what I would do with $1 million is I would probably, first off, I would keep probably 10 to 20% of that. So I'd probably keep $200,000 cash on hand. And that's just because that is a lot of money. However, the reason I would do it that way is because I know a crash is coming, Cole. So if I can hold on to $200,000, that's how I would do it. Now, another thing I would do is I'd probably I got 20% there. I would probably put about 50% in the real estate. So I would buy, with $500,000, I can probably buy about a 32-unit apartment complex. So obviously I would look at the net operating income. So what is the income of the property after all expenses? What is the cash flow? Is it a great tax write-off? Where is the location? Location is the most important thing in real estate. That's just a side note for the asset vehicle that I would go in. And then, so what am I at right now? I just said 50%. So that's at 70%. So then with the other 30%, I would probably do 10% in crypto, and I would do 20% in the stock market, while also maxing out my Roth IRA.
For sure. Okay, so talking about the crypto, you said 10% you would put into stocks and crypto?
Yeah, 10%, and it really just depends. I'd work with that 30%, and I'd probably either do 15 crypto, 15 stock market, or I would just do 20% stock market, 10% crypto, or vice versa. It really depends on the state of the markets during that time. Like if you were to give me $1 million right now, I'd probably put that 20% into the crypto markets instead of 20% in the stock market. Well, you're going, why? It's because all these large market capitalization companies, Apple, Alphabet, Google, all these Amazon, they're overvalued companies. Their PE ratios, price to earning ratios. And Cole, I have some charts I can pull up too if you want to look over some of these.
I guess one more question before we dive into that is, I'm a new investor. I'm 19 or I'm 29 and I'm just starting out investing here. Would you suggest me investing in stocks, or should I go down to the crypto role? But like, I don't know what I'm doing. So what do you suggest?
So the first thing I would say, if you don't know what you're doing, obviously, is research more. Start studying companies and people that you can learn financial education from. And then from that point on, you need to start understanding the assets. Okay. So if you want to invest in Bitcoin, you need to ask yourself, why do I want to invest in Bitcoin? I talk to so many people that are in crypto. None of them hardly know anything. They don't even know what Bitcoin is half the time. They're like, oh yeah, I've heard about it in the news, but I'm invested in it. Or Dogecoin. I'm like, dude, do you know Dogecoin is super manipulated? One new Doge is literally made like every minute or every second or something crazy.
So like, crazy like that.
It's there's not a refined amount like Bitcoin at 21 million, and it doesn't add a potential amount of value. The only value you have is, well, it could go to $1 because Elon Musk could hype it up to $1. But what value does it really add? It doesn't add much value. With Ethereum, you have smart contracts. With Bitcoin, you have the AI super soldier, a gold reserve of a crypto asset. Would I suggest stocks or crypto? First off, that would depend on the individual. How much money are you working with? Let's say you got $1,000. I'd do 50-50 split in between. The reason I do that is because I want to diversify my portfolio a little bit, but I also don't want to, go full balls in on one asset. I rather diversify a little bit. And so what I would do if I had $1,000 right now, I'd probably go 25% Bitcoin. So 2,500 Bitcoin, 2,500 Ethereum.
So your first, just hearing by what you're talking is your first thing is your crypto. So,
yep.
Okay.
Yep. And the reason I'm saying that is because the markets just had a correction, a little bit of what I call a flash crash. So if we dive into some of these metrics, we can kind of go over it. I don't have the 2015 to 2017 bull market popped up, but I do have the statistics, and people can fact check me. But we are still in a crypto bull market. In the 2015 to 2017 markets, there was 7 crashes for an average of 30%. And in the 2021 market, we've only had about 4 or 5. And the recent one we just had was a 56% drop. So this is a great time to buy the dip. As we like to say at Brotherhood Finance, buy low, sell high. So we can accumulate more of those assets and more of those Satoshis. For those who you don't know, there's 21 million Bitcoin, and then each Bitcoin is actually divisible by what's called a Satoshi. And there's 100 million of those Satoshis. You're going, okay, why did they do it like that? That's so you can fractionally buy a piece of a Bitcoin if you want. You don't have to buy a whole Bitcoin. You can put 10, 20, 30, 40, or $1 into Bitcoin if you choose to do so.
So, obviously you have something for us. And if you guys in the comments, if you guys have any questions as we go throughout the podcast, let us know. We'll pin your comment on the screen and maybe talk about it. So, I know, Brendan, you have something for us here. Why don't you pull it up?
Yep. Can you see it?
Yep. I'm adding it to the stream right now. So what are we looking at here? So obviously we see a stock to flow model. What is a stock to flow model?
Yeah. So if you just look right here, I'll just read over a little bit. So this is a stock to flow model for Bitcoin, right? And this is just look into Bitcoin.com. This is one of my favorite websites. So a stock to flow is a ratio that they use to evaluate the current stock of a commodity. So the total amount currently available against the flow of the new production. And since we know how much there is in crypto and specifically Bitcoin at 21 million, we can measure the stock to flow of that asset. And we can kind of predict where it's going to go over time based on a 365-day moving average of that asset. So again, this model treats Bitcoin as being compared to commodities such as gold, silver, or platinum. These are known as store of value commodities because they retain value over long time frames due to the relative scarcity. It is difficult to significantly increase their supply. The process of searching for gold and then mining is expensive, and it takes time. So if you guys don't know, the blockchain network, which is what everything is ran on, when you buy, like let's say I send Cole some Bitcoin. So they're going to run that through the blockchain server, and it's going to be checked through those miners. And those miners are rewarded with a small amount of Bitcoin for fact checking that, okay, I sent that to Cole. And it's very publicly open. Anyone can see it. You can look on it on BlockFi or on on the blockchain network overall. So the people like Nancy Pelosi, Janet Yellen, they're scared of Bitcoin because they're some of the most corrupt politicians that have ever been in the government, and they don't want you to know what they're spending their money on. Actually, as a matter of fact, they're insider traders. The stock to flow model right here. So if we look, so there's what's called halving cycles, and these usually occur in Bitcoin about every 4 years. So what that means is we're currently mining at 840 Bitcoin a day, and that's going to be halved. I'm not sure on what year. It looks like it's going to be on 2022 is when the next halving cycle occurs. So then that halving will occur. So if you look right here, though,
what's a halving cycle?
Yeah, so the halving cycle is when the amount of Bitcoin that is mined on a daily basis is halved. So you're going, okay, why are they doing that? They're halving the amount that you can mine, so therefore the price of the asset goes up because as the demand is increasing, you have banks, you have BYN Mellon, you have Citibank, you have all these large banks that are going to be implementing Bitcoin onto their balance sheets or just as a way to buy the asset through the banks here soon. But the halving diminishes the amount that's mined. So obviously with it at a certain cap at 21 million, it increases the price overall. So if you look at Bitcoin, it's currently at about 31,600 USD dollars. And it's below this stock to flow model right here, this red line. So this is the 365-day moving average. So in order for it to even be on the stock to flow model right now, the asset would have to be somewhere around the $75,000 to $80,000 price range. So the asset's very undervalued. So that's why I would say the first thing I would probably buy is some Bitcoin and Ethereum. Now, that's not financial advice. That's what I would do. But that's because I like to buy assets that are at lower price valuations.
So obviously everyone saw Bitcoin crash here, and so would you suggest obviously them kind of going into more of a Ethereum route, or do you really have faith in Bitcoin that it's going to hit that 75, 80K like you were saying?
So my price prediction by the end of 2021 still holds. I still believe Bitcoin is going to be $100,000 asset by the end of the year. I think more banks are going to get into it. I think there was a lot of, obviously you have the Elon Musk, and then you have the energy problem, which is pretty funny if you actually do some more research on it. I mean, Bitcoin doesn't really use a whole lot of energy, especially compared to other banks. And banks won't even release how much energy they actually utilize for the banks, the bankers, the accountants and stuff that are at the banks. I mean, you got to remember they're utilizing all that electricity, that office space. So they actually probably use a substantially amount of more energy than Bitcoin does, as well as Bitcoin. I can send someone $3 million that lives in Africa in 25 seconds. If I wanted to do that, with a bank, it would be a lot more difficult. I would get probably charged a significantly amount more. And as well, the asset of that, the return I would get on that asset over time has been increasing, while the US dollar has been decreasing because, again, the more money they print, the lower that dollar is going to be worth over time. Yeah. So another chart I want to dive into real quick before if we dive into the stock market. Where is it? I think it's the pi cycle top indicator. Yep. So the pi cycle top indicator. So what this is the pi cycle top indicator has historically been effective in picking out the timing of market cycle highs to within 3 days. And it uses the 111-day moving average and a newly created multiple of the 350-day moving average.
So what are we looking at here? Obviously, is somebody that's not very, very profound in obviously crypto and is not really like maybe a beginner or even amateur. I'm not going to know what a pi cycle top indicator is. Can you kind of explain, I guess, what it is in your own words?
Yeah. So when you get into professional trading and what these day traders and financial firms and a whole bunch of other asset managers utilize is they use things like the 365-day moving average, which looks at the asset over a 365-day time frame, and it can interpret over since Bitcoin's been out since I want to say 2013 or no 2008, around where the last recession happened. Which, by the way, we're in a way bigger bubble than the 2008. The only reason we're still in a recession right now, the only reason we have not crashed exponentially and even slipped into a depression is because, like I was saying, they've printed 24.5% of every US dollar in the past 2 years. So they're pumping all this money into the markets, keeping people's 401ks afloat, keeping their retirements afloat. By the way, pensions are broke. We're going to be paying pensions for many years to come. So that's another problem in itself. Our generation is going to have to be paying for a lot of retirees that's coming up soon as well, especially the boomers. So that's something that we're going to have to be paying for. And people have to understand too, they're printing out this money. People don't even really want to work right now because they can sit at home and collect a higher paycheck than they would working at, like you were saying, McDonald's. But the problem with that is we're going to have to pay that money back at some point. And the way we're going to have to pay that money back is through taxes. And another reason why the U.S. is doing that is because we're such a huge debt nation. I think, what is it, $29 trillion now, Cole?
Yeah, it's something serious.
We're such a huge debt-filled nation now that they want to increase the debt, so then the money we owe in China and these other countries is worth less, but it's robbing the poor and the middle class of their wealth because they're saving more money and not even able to invest in asset vehicles that will keep up with inflation. So people are going, oh my God, my house value went up 18, 20%. Well, really, your house value didn't even go up 18 to 20%. It's just the value of the dollar went down 18 to 24.5%.
Yeah, it's crazy because I'm sitting over here and I hear my neighbors talking. Oh my God, man, my house is such a good investment. I'm glad I bought it when I bought. A house is not an investment. A house is a liability. And it's the same thing with the car market right now. Obviously, the cars are going way over sticker price. I mean, I went over to GMC the other day and like I think one of their trucks was going for 70 and it sold for 85. And there people are selling their cars and like, oh my God, I made more money than when I bought it for. That's such a great investment. That's not an investment.
Yep. So real quick, I want to finish up the crypto real quick. I want to dive in real quick what the pi cycle top indicator was. So like I was saying, the professionals use this. So if you look at these two lines right here, so the last chart we looked at kind of showed the 350-day moving average also. So this green line right here is the 350-day moving average of the price of the given asset, which would be Bitcoin in this circumstance. And then this yellow line right here is the 111-day moving average. Now, if you scroll down, like I said, it uses the indicator for picking out and timing the market cycles to within 3 days. So obviously, if you look at Bitcoin, which is this solid blue line right here, this line is right here on, it's the 26th now, but was at 31,600, like I was saying. So here are the two lines for the 111-day moving average, and here's the other one for the 350-day moving average. So this is still indicating that the asset is under valuation. So it's still a great time to buy the asset. Now, if the asset was trading around $50,000 to $60,000, it wouldn't be as good as a buy. However, since we're still under that, it's still a great investment. One thing I want to bring up real quick, by the way, if you've watched this far, I appreciate all you guys. Make sure to leave a like, smash that thumbs up button, and check us out on our TikTok at Brotherhood Finance and our Instagram at Brotherhood Finance. We appreciate all the love and support. We hope you find massive value out of this.
Thank you.
But so here is the, this is our Instagram real quick. I just want to dive in this video, Cole. Can you see this right now?
Yes.
I don't know if our audience can hear it or not. Probably not. But if you look right here, this is the stock to flow model for Bitcoin. And this dude is showing that the 1,458-day moving average right here.
So he's showing basically that Bitcoin is undervalued and why it's going to exponentially rise here in the next coming months.
Yeah, he's showing the stock the flow model with the halving cycle in it.
Mm-hmm. So he's saying it's for 342,000. That's how much Bitcoin's going to cost.
That's how much Bitcoin will be if it continues to follow that stock to flow model by 2022, and then that halving a cycle occurs. That's what he believes. Yes. And that's just based on a stock to flow model I wanted to show up real quick. Now, before we dive into some other things, I want to obviously show a bit about where I was coming up with these theses and overview of why I am saying the stock market is pretty overvalued. So one thing I want to look at obviously is if we look at these assets. Now, if we dive back into the 1929, the Great Depression, right? So the same exact things were occurring if you notice and you dive into some of the research.
Yeah.
So you have real estate, all-time highs, right? You have the stock market. People were freaking out. They would literally just dump any money they had in the stock market, kind of like Wall Street bets. Oh my God, the stock's going to explode. People would put a whole bunch of money, a whole bunch of, of their liquidity and their wealth. And we're talking about in 1929 to, I want to say it was like 1940 it happened. It was about a 12-year depression, I believe, something in that essence. Within that time frame, these assets, their assets dropped anywhere from 85 to 90%. And again, that's because we were in such a huge bubble, and it's been getting worse and worse. So obviously, I'm just for our audience to know, they're going, okay, well, why is my dollar continuing to go down in value? What you have to understand is we used to be on the gold standard. And what the gold standard, by the way, in 1971, President Nixon took the dollar off the gold standard. So you're going, okay, why does that matter? Well, when Nixon did that in 1971, he made it so the governments can print as much money as they want and as they choose to do so. So when this COVID first occurred, nobody expected this to happen. And we all thought, what's going to happen? But what happened was the government printed so much money that it just pumped right back in the markets, and it made that bubble even bigger and bigger. So if you look at some of these metrics here, this is just over time. So, obviously this is your Yardani research, like I was saying. I want to look at more of the forward PE ratio, so the price to earning ratios.
So before we dive into this real quick, explain to me or our audience, what is a bubble? Like, why should they be scared of this bubble that is happening? And like, what's here to come?
Yeah, so I can't really tell you exactly what's going to happen. But based on, the financial education and everything and my research and what I've been, diving into for roughly the past, give or take, I would say 8 to 10 years, is we are in a bubble right now. And you can look at multiple indicators of why we're in a bubble. But when you print, so much money. Now, I don't know when this crash is going to occur. But as we know, history repeats itself, right, Cole? If you study history, history is going to repeat itself. So when you print a massive amount of money and the markets are at all-time highs and the economy is not reflecting based on the gross domestic product, GDP, which is pretty much the goods and services and how much we're producing and how much we're selling, since we're not growing very much as an economy. No. And like I was saying, we're still in a recession. How long until that bubble pops? I don't know. But should people be frightened? Yes. Should they worry about it, throughout the every single day of the week? And, oh no. And no, they shouldn't. But you should keep some cash on the side to be able to invest in these assets when the valuation and the price of them goes down overall.
So if I have, let's say for an example, I'm a college student or even out of college, or it doesn't matter how old you are. And let's say I have $8,000 to $20,000 in my bank account just sitting there. What should I do with it? Should I pull some out in cash and plug it in, or should I put it in the stock market, the crypto market? What should I do with that just 20,000 I'm sitting in my bank account?
Yeah, so 20,000, the first thing you want to do is never keep all your money in a bank, because again, what does the bank do when you get your money, Cole? I'm sure you can answer that. If I give a bank $1,000, what are they going to do with my $1,000?
They're going to at least take 9,000 of that and loan it out.
Yeah, they're going to take $900 of that $1,000, and they're going to loan it out and make money off the money you gave them. That's why do you think banks were created? First off, they developed this great mindset. Let's get a house. Why is houses the number one thing banks will loan you money on? Because they make a substantial amount of money from loaning you that money for that house. Yeah. So, they got together like, oh, a house is the American dream. A house is the American dream for the banks, because they don't have much to lose in a house. They can charge it, 3 to 6% or whatever interest rate you get. By the way, credit is hugely important. I want to come out with a video on building credit and why credit's so tremendous. Like I was saying, the rich don't use their money; they leverage other people's money, and they use the bank's money. They use other people's money to buy those assets. So it's very important to build your credit score, especially at a young age.
9 out of 10. You're saying 9 out of 10% of the time, or 90% of the time, the banks are loaning out your money,
of course,
and you don't even know it.
Yeah, they sure are. So again, that's why when you look on your phone, most of it's digital. and you can also only withdraw certain amounts of money out of your bank at a given time. So again, that's because they loan out the money. They don't keep the money. Like when COVID first occurred, they had a liquidity problem. That's another reason why they had to print a tremendous amount of money. If you study the Great Depression of 1929, the banks shut their doors. They weren't giving people their money. They didn't even have any of the money to give to people. So they literally, you had a hard time accessing your money if you even got any of it during the Depression.
But in 1929, we were also on the gold standard, and everything was backed by gold. So
right, we couldn't print trillions of dollars.
Exactly, we were in that tough time. Yeah.
So these are different times, but again, history repeats itself. So I mean, again, like I was saying, if I was a college student, going back to what your statement, what would I do? I would, I'd probably hold on to about 20 to 30% of that in cash.
Okay.
And then I would invest the other into assets. Now, what assets, that depend on what your risk tolerance is, what your education is, how you want to make that investment overall. But what I would do is I'd probably take some of that money out of the bank and I invest in hard assets. So I'd probably invest in Bitcoin, silver, and gold. And probably Bitcoin over gold, because gold hasn't returned anywhere near the type of return on investment that Bitcoin has over the coming years.
And we suggest Bitcoin, obviously, to, if we look back at that video we just watched, and more professionals, they're saying Bitcoin could hit
model.
Yeah, so you could hit $500,000.
It could hit $1 million. There's some outrageous
$1 million for one Bitcoin. So I guess
some outrageous predictions
that's crazy to me. That is crazy to me.
You got to understand, the mass adoption curve of Bitcoin has not occurred yet, because crypto is such a new space. It's funny. I was outside with my father today, and we were doing some work on the cars, and he was going, the internet came out, it started getting, around like the 1990s, 1995. I'm like, no, father, that's when you figured out the internet was around. That's when the adoption curve started to occur. The internet and all that stuff started occurring, a little earlier than that. I mean, a lot of the stuff happened in the 80s. I mean, you got to understand the way that technology has advanced over time. I mean, Pac-Man, used to be a game that our parents used to play.
Oh, yeah.
So, I mean, and now look at how technology has innovated. And it's going to be the same way how it happened to movies, how it's going to happen to money. And if you actually dig into it, you have China. They have the digital yuan. You have countries now, El Salvador, I believe it was. They just accepted Bitcoin as one of their world's currencies.
It's their actual currency, that you can go to Walmart or whatever they call it in El Salvador and actually buy your food with Bitcoin. That is crazy to me.
Massive event. And people are going, well, that's not very substantial. It's the adoption curve. Like I was saying, I think it's statistically, it's only about 13% of people actually know much about crypto or own any crypto at all. Other than that, most people are not educated. And that's why me and you like to get on these podcasts, and we like to educate our audience, especially our brothers, why they need to understand and need to learn more about investing in the asset vehicles, especially crypto and the stock market, and how you can invest in real estate and all the taxable advantages and returns you can get out of those assets.
So let's dive into what you wanted to present us here. What are we looking at?
Yeah, so we're looking at the forward PE. So the forward PE ratios, like I was saying, the PE, what is a PE ratio? It's the price to earnings ratio. So these are the forward PE ratios for the S&P 500. So you have the S&P 500, then you have the Dow Industrial Average, which are different industries. So the S&P 500 large cap. So right here, if you look, it's at 21.3. And if we look, look at 2007, 2008. You notice that there was a huge drop in the PE ratio. So these companies right now, their price to earnings ratio are substantially high, way too high. And if you actually look, the small caps right here, 2008, this time frame, are actually better valuation. So I know you ask me sometimes, Cole, why aren't you invested more in these large capitalization companies like Amazon,
like Tesla,
Google, and Tesla? And it's because these companies are so. Although, Tesla does provide electric vehicles, he has very many other different industries. I think we are going to see electric vehicles. Probably most of them are going to be electric in the next 10 years. However, the companies are very oversaturated, especially their valuations. So if you look at the small market cap right here, it's around, what is it, an 18.2% is the PE ratio. Price divided by a 52-week forward. Obviously, there's 52 weeks. So expected operating expenses per share. So the small caps, even the mid caps, but look at the large caps, a 21.3 PE.
So
So
looking,
obviously,
just me looking at this real quick. What was that? And I saw a big dip in the S&P 500 and the just the Dow in general. When was that big dip? If you can go back to the right there
yeah.
about all the way into it looks like 2019, 2020-ish kind of. It had like a huge like just dip. And can you explain kind of what happened there? Is that something like 2008? Like if I'm looking at this and I see that, I was just like, wow, like what happened? Is that inflation that just made that shoot up like that? Or it looked like it was going to do a correction and then didn't.
Yeah, so I mean, you have to understand they've been preying and manipulating these markets for many years, and what the government and a lot of the Fed doesn't understand is eventually, like I was saying, the bubble is going to pop, and when that bubble pops, these assets are going to get completely demolished. However, if you use time as your best asset and you're a college student, if you're going to invest in the stock market, put in a Roth IRA. You can't lose long term. Long term, you're going to what did you say? 3.1 million, 18 to
Yeah.
59 and a half if you max it
Yeah.
out, and that's non-taxed. So by the time you pull that money out, you're not getting taxed on that money either. The biggest expense you have as an employee is taxes. You're going to have to pay a substantial amount of taxes, and that's why business owners, if you study the rich, like I was saying, the rich own businesses, they own real estates, and they own stocks. They usually own some form or method of those three asset classes.
Of course.
Yeah.
So I guess
that's the forward PE ratios right there.
So one thing I want to dive in before we get going here is what I heard someone telling me when I was reading this, and I know I want to talk about it a little bit, is the three types of income. I know 90% of people don't know there's three types of income. So as we dive into the three types of income, what are the three types of income? We have passive income.
Yep. Passive income is
earned.
income you're earning that you're not working for, that is coming from a given asset.
We have earned income, which is
you're an employee. You're working for someone and you're making them money, and you're pretty much making their company money. And earned income is the highest tax income. Again, it's probably what about 90% or more of the population does for a living. They get earned income.
And then you have your market income, which is your stocks, your bonds, your
portfolio income,
your and all that stuff. So how is that taxed? I guess on a scale, I mean, you got obviously your number one, which is your earned income. That is your most taxed. And then after that, what do you have after that? You have passive income, which isn't taxed. And then your portfolio.
Yeah. So again, earned income is the highest tax out of them all. And then passive income is where you're not really going to have to pay any taxes. So if you study, people were mad at Donald Trump, and it's because he doesn't have a job. He has businesses, and then within those businesses, he owns real estate. Obviously, Donald Trump created his net worth by, as Robert Kiyosaki would like to say, green houses and one red hotel. And you don't pay taxes when you provide housing. You get that cash flow, appreciation, and tax write-off. So earned income is one of the worst incomes you can have, and it's what most people have. But if you collect earned income, invest it into an asset, and then get that portfolio income where you don't have to pay as much capital gain. So invest in a Roth IRA or something like that, where you're going to get tax deductions at the end of the year as well. But try to focus on getting your passive income higher than your earned income. And then I think that's what, if most people started focusing on that, I think that's what would allow them to have that financial freedom, as well as obtain their goals and have freedom for themselves and their families.
I totally agree 100% with that. Well, with that, concluding the rest of our questions for today and wrapping up this podcast, make sure you guys go down, leave a like, support us. It really gets us fired up when you drop that like. Thank you for 5 likes already, and I think we had 4 or 5 people at once. But if you guys have any other questions as you see this now, or whether you see this tomorrow or next week, let me know down in the comments below. We're definitely coming out with a podcast here real soon with Real Marshall Wilkins. That's his Instagram, or Marshall Wilkins. He's a $2 billion
$2 billion
man.
construction real estate marketer and negotiation expert. Again, brothers, I appreciate you all stopping by. Make sure to leave a like, smash that thumbs up button, follow us on all of our social medias. If you have any questions for the next podcast we have, leave them down below. We hope you found massive education and information out of this podcast, and we appreciate you stopping by as always.
Have a good one.
All right, peace.